In our 2026 private credit outlook, we suggested that the market is experiencing a collective Dunning-Kruger moment, a well-known psychological phenomenon explaining the relationship between knowledge and confidence that progresses in 4 distinct phases. Initial hubris, high confidence, though knowledge is low, shaky confidence as one learns more, followed by the valley of despair, in which one's now moderate knowledge causes confidence to crater. One may doubt what they think they know and fear that of which they may still be unaware. And at this point, many throw in the towel. It's just not worth it. I will never figure this out. That's the valley of despair. And for those in the private credit industry, it certainly feels like that's where we are today. Headlines proclaiming private credit's demise are inescapable. But what we often find are sort of half-truths or fractional analysis that's then extrapolated into much larger claims about the market holistically. But amid the frenzy, too few have stopped to ask the most basic questions, often the most informative. For example, if the economy is strong, corporate margins near all-time highs, and distress across high-yield syndicated loans and bank commercial lending, markets parallel to private credit, is low, how exactly is it that private credit alone is supposedly crashing? Please explain. How about the fact that the aggregate leveraged credit market, in spite of private credit's growth, has shrunk as a percentage of GDP each year since 2020? But wait, it's a bubble, right? Unlikely. Bubbles usually grow. What you may find is that the loudest voices are the ones offering a logic that requires the greatest leap of faith. Instead, there's likely a more grounded explanation. As higher rates escalated the income-driven return on core direct lending, private credit attracted new adopters and increased attention. So instead, the level of angst may better reflect the collective learning underway than the true state of corporate borrowers. To that end, recent events should be an urgent call to double down on education. And we hope this podcast is helpful in serving that objective. Because there's only one way through the valley of despair, and that is to stay engaged and continue to learn. Reaching the final stage, the so-called slope of enlightenment, means recognizing that though reality has been sensationalized, the playbook is indeed changing. Maximizing the value private credit may provide now requires a different approach. It's not time to throw in the towel. It's exactly the opposite. It's time to dig in and differentiate on the value proposition you provide. Be there and be present to guide and inform, especially in times most challenging and uncertain. That's the standard for true partnership we seek to provide, because delivering a solution for clients' income and diversification needs is worth it. Joining me today are 2 gentlemen who never call it quits, Andrew Korz and Rob Hoffman. Andrew is my podcast co-host, Senior Vice President of Investment Research. Thank you for joining.
Great to be here, Alan.
And we're joined by a special guest today to talk all things credit, Rob Hoffman, Future Standards Head of Credit Solutions. And, Rob, we're really thrilled to have your perspectives on the podcast today. Thanks for joining the show.
Great to be here. Great to be back in the hot seat.
Rob has, a good background with investment research. He used to lead investment research. We've brought out the heavy hitters today. We've got 2 CFAs here. I'm a candidate for level 3, for whatever that's worth.
Should be able to screw in a light bulb.
It's not, exactly. So hopefully some insights that are helpful for a timely conversation. And what we really seek to do today is address some of the top headlines and things that are causing investors and commentators looking at the market to be a bit skeptical, to question some of the fundamental value proposition that private credit's consistently delivered. And so what we're going to do is tick through and list off some headlines. That'll lead us into discussion on those key topics. And the first that we'll get into today is a discussion on PIK interest. And of course, PIK interest is the principal balance increasing being the form of payment of the interest instead of cash pay, as is typical. And Rob, I'd really like to start with, your view on PIK and how people should think about that conversation.
really categorize it as the market's latest concern, because I'm pretty sure this is a topic that we probably talked about 18 months ago when it was the market's latest concern back then. In my mind, the concern about understanding PIK is actually relatively complex, because there are a multitude of different reasons that a company utilizes PIK in their capital structure. I think everyone focuses on the worst case scenario, which is you have a company, it's on the brink of bankruptcy, it can't make payroll, they have to conserve every last dollar that they can just to survive, and so the debt goes PIK, but it's not like the company's in fundamentally a good shape. And that describes some PIK in the marketplace. But I think most of it is not related to that. And you have everything from some PIK is used in some strategies to help get equity-like returns. The debt's got an 8 or 9% coupon, but the lender deserves some extra compensation for some reason. The company can't pay another 3% cash, but the value is there and the company is growing, and it should be there to the benefit of the lender later on down the road. And so you can use PIK as almost a equity-like incentive without actually having to dilute your equity. Or some structures today where a private equity firm buys a business, and in those first couple years of the life of the business, they want to reinvest back into the company. And so the lenders give them the ability to pick a small portion of the overall cash spread on the loan so that they have some extra capital to support the business. Most of it is still cash pay, and after 1 or 2 years, they lose the ability to do that. And I think it's a lot of these other forms of PIK that are driving a lot of the PIK. And I know you guys have the stats on just PIK overall as a percentage of the market. This is not some new thing that is skyrocketing out of control. It's pretty well contained and well understood. Everybody reports it. It is certainly worth understanding and where it's coming from in a specific portfolio, but it's not this all-out boogeyman that I think sometimes it's made out to be.
Just look at the numbers. I mean, we have the data on the BDC market. I mean, we've gone from so this is as a percentage of total investment income. PIK was about 4% of investment income a decade ago. It's 7.3% today. I mean, it's growth, but like over a decade, I mean, you've gone up 3 percentage points. I mean, I wouldn't call that, and I would also add that it hasn't gone up at all in the last 3 or 4 years either, right? So you had this spike out of COVID where you had a lot of companies, who were struggling, because maybe they're a retail company, they had locations closed, whatever it was, and, you needed some relief from the lender, and you had this spike, and things have flattened out since then. I will say that certainly the sort of PIK toggle element that you mentioned, I sort of think of like PIK as like sort of 3 categories. You've got like the restructured PIK that people kind of call bad PIK. On the opposite end, you've got like the very structured PIK, which you mentioned is like maybe some higher return target deals, more complex deals, but it's structured as part of the investment thesis. And then the middle is kind of the squishy area where it's like maybe like it helps make the math work to win a competitive deal. It helps you take on more leverage, right? Those types of things. And those can vary, I think. I feel like that middle ground is where you've specifically seen the upper end of the market, as sort of competition has increased a bit, is like that marginal increase in PIK has probably come from those types of deals, right? The PIK toggles, right? But by and large, the numbers, I mean, they're not nearly as concerning as people might be portraying.
I would further delineate it as well too. Andrew referenced the additional increase in sort of PIK toggle at the top end of the market as maybe like a competitive factors thing where the BSL market's pricing deals exceptionally tight. One of the things that private credit can offer that the BSL market typically can't is PIK features that may be done to help win deals at that part of the market. But that's one of the reasons why you see PIK slightly more elevated at the top end of the market. Roughly 7.6% for upper middle market, large cap direct lending deals, as opposed to in the lower middle market, it's more like 5%, as it's a less standard term and lenders typically have a bit better negotiating position or not directly competing with the BSL market as frequently as the top.
Last thing I would say too is like in BDCs specifically, there is a ceiling here, right? BDCs need to pay out 90% of their income as a RIC, right? And like if you're picking a bunch, that's not cash that's coming in that you can then pay out, right? So you can't really go much higher on pick and BDC. Right. So like if there's any concern that like this is going to just keep rising, A, the data says that it's not, and B, there is like a ceiling here that you can't go above.
Yeah.
Sure.
Yeah, I agree with all that.
So for our second topic, I'd like to address redemptions. A lot of headlines of late, obviously, and when we talk about the valley of despair, I think this is one of the keynote attributes of being at that part of the market and that part of the Dunning-Kruger curve, as we mentioned in the intro.
A lot of what we're talking about here, it has certainly caused people to hit the sell button. Let's sell now, ask questions later. And so there is no denying that when we look at redemption activity across funds, that redemption activity is up. And many of those funds have gates because the underlying investments that a lot of these funds hold are not readily liquid and tradable. That's how they've generated better returns than public credit, trading that illiquidity premium. And those gates serve to then protect the funds from having to be forced sellers to meet those elevated levels of redemptions. I think that in the context of private credit, these types of evergreen, more private wealth or retail-oriented vehicles, they're a decent part of the market, but they're not the entire market. It's not going to cause the whole thing to come crashing down, in my view. And the funds have natural protections to protect against that. So, and lastly, you still see inflows. A lot of these funds, there are still consistent money coming in. It's going to pull back. It's just the nature of the cycle that it's going through right now. But I'm not sure it's this in and of itself is the end of the market just because you see a pickup in redemption activity, especially because, and as we'll talk about later, the underlying fundamentals in the market are still pretty good right now. So people are still going to be making income and making decent returns. It'll be interesting to see how long it lasts.
Your point on liquidity is perfect, right? Like, private credit is unique in that it has this natural, organic, liquidity cycle, right? Where like loans are paying off, you're raising capital, you're getting interest off the loans, so there is consistently cash coming into the fund to fund these 5% a quarter redemptions, right? Like, I compare that to, and people say these structures have never been through a cycle, a stress period. It's like, well, we have non-traded REITs that went through a, terrible correction in the real estate market and are now coming out the other side. But we had gates thrown up in the non-traded REITs, right? And real estate is a much more challenging asset class to manage through in these structures because it doesn't have that natural liquidity. You actually have to go out and actively sell a property.
You own a building until you decide to get rid of it.
And
that's very different.
And if it's an illiquid market, like, good luck.
I mean, your typical loan, while it may be structured with a 5 to 7 year maturity date, typically refinances after about 3.5 years.
Right, and maybe you push it out to 4.5 if it's a bad market, but like...
normal market conditions, you've got 20 to 30% underlying turnover in a credit portfolio, which to your point is very different than a lot of other asset classes, plus other forms of liquidity that exist within these structures. There is a pretty decent runway to meet redemption activity in line with the gates and where these funds set those.
Yeah, and I'd also like to draw a bit of a contrast too. I've seen many articles compare the gates with private credit vehicles today to the GFC, and many hedge funds and real estate credit related funds that threw up the gates then, and it's the exact same scenario, and therefore there must be similar levels of distress and asset deterioration in the portfolios, which we'll get into that a little bit more so here shortly. But on the gates specifically, I think one of the big distinguishing characteristics is the limited liquidity features with private credit vehicles today is very much a standard upfront function of what these vehicles are and what they're intended to be. And as a result, it allows the ability to deliver an asset class within this wrapper that makes sense for private wealth that's outperformed the syndicated market by 370 basis points over the last 5 years on average, and high yield by over 500 basis points over the last 5 years on average. That's a meaningful thing to be able to offer. And the distinction to the GFC is really, those gates that were thrown up then, and Rob, I'd love your perspective on this. You were in business at that point in time. Those gates weren't necessarily like an upfront feature. It was more like, the manager had this ability buried deep on page 400 of the legal agreement.
And we're in crisis, so
so we're going to throw it up and stem money going out the door in an asset class that is deteriorating rapidly.
Yeah.
What happens now is, if you don't get redeemed in full, there's the ability to, submit to get liquidity the next quarter. The money that wasn't redeemed will be continued to be invested in the fund, earning interest. And principal is still what it is, and earning return over that period. It's not as though you got 60 cents on the dollar because only 60% of the pool that was requested was fulfilled for that particular quarter.
Yeah, and those investors today are redeeming and getting NAV. They're getting where the fund was most recently valued. Those values have not deteriorated to any significant degree for the vast majority of the private credit markets. And in many cases, a lot of the investors that are redeeming have gotten 50 to 70% of their capital back, which is we think about, okay, people need to de-risk because they're concerned. There's a lot of de-risking that's occurred. But I think most importantly, to your point, in a lot of those gates, back in the financial crisis, markets were sinking, prices were plummeting, NAVs were deteriorating, and then you also got stuck. That's just not what's happening right now. You do have gates, and there are limits on those redemptions, but share prices have been very steady. Income is still very consistent and very strong. And a lot of what has underpinned that great outperformance that private credit has delivered over the past many years versus public markets, that dynamic hasn't changed.
And I want to pick up on that before we move on real quick on this idea of an illiquidity premium, which you both mentioned. And I think a lot of times we say that, but we don't really dig into why it exists, right? Oftentimes it's said these assets are illiquid, and as a result, to protect the structure and to protect investors, we need a relatively illiquid vehicle, and that's all true, right? But I think you can also put it in reverse, right? The illiquidity of the vehicle allows the illiquidity premium to exist, right? So think about it, right? You've got a borrower who's out there, big PE sponsor looking to finance a deal. I've got options in the broadly syndicated market. I've got private credit options, right? The private credit option is more expensive. It usually is, right? But, it executes faster, and I don't have to worry about the market moving away from me. I don't have to worry about the deal getting hung or spreads widening, right? So I say, hey, I'm willing to pay the private credit lender 150 basis points extra in interest to take those risks off the table, right? And as a private credit lender, I can give that assurance that the capital will be there, right? I have the credibility to say, investors can't leave tomorrow, and all of a sudden I got to tell you, sorry, the money that I was going to give you for that loan, I don't have it anymore, right? So the credibility to offer that certainty of execution only exists because you can offer certainty that the capital will be there, right? So the illiquidity premium falls directly back onto how these structures are, how these vehicles are structured, I should say.
Very well said. And that sort of leads into the next topic on structuring, as you mentioned there at the end, which is bank leverage. And obviously, Jamie Dimon's been out, been critical of private credit for some time now, saying that there would be more and more cockroaches. I think, the evidence of that's been somewhat limited thus far. There's defaults in every credit market, but that doesn't necessarily mean that there's an impending doom, so to speak.
Just to start us off, and then Rob, I'll kick it over to you, but just maybe if we broaden out a little bit, right? There's always these comparisons to the GFC, perspective, yes. Leverage on top of leverage, and it's scary. It's first of all, the amount of leverage we're talking about is orders of magnitude less than what we're talking about in the GFC. If you just think about a regular deal, right? Again, a PE sponsor's buying a company, they're putting in their own equity, right? That makes up about 50% of the capital structure of that company, right? Then maybe a BDC comes in and they're going to finance the other 50%, right? And that BDC has maybe 1-to-1 debt to equity on average. So you have bank capital that comprises the safest 20% of the capital structure, right? So if you think about it from an LTV perspective, that company's value would have to fall by 50% before the BDC investors lost a dollar. And then it would have to fall another 50% before the banks would lose $1, right? So, the value would have to fall 75% before the banks would be impaired, right? So just as we start the discussion, like that is an incredibly low LTV, and it's a really good business for the banks. But I think we need to remember sort of the level of leverage that we're talking about, and the attachment points matter.
Yeah.
Right.
No, I think you're right. I mean, most private credit funds in the market do use leverage.
Yeah.
So everybody gets a little bit concerned. There's leverage on leverage. But to your point, the regulations around the amount of leverage that you could use in a BDC or the amount of leverage that you could use in a closed-end fund, which is even less than that, it's a pretty small amount of additional leverage in the context of where leverage has gotten people into problems over the years. And furthermore, for your analysis about what would have to happen for the banks to start to become impaired, you also have these features like what was reported on in the press, that they also have the ability in some of these structures to adjust the values of the loans that the leverage is being drawn against so that they can reduce their exposure if necessary. We went back and talked to our capital markets team, and they're like, first off, not to name names, we're like, the banks are still open for business.
Yeah.
If you have a new private credit fund, these banks are still more than willing to lend to you today. So this is not that they have closed business and are pulling back and reducing exposures. They are still more than willing to lend.
Yeah.
This feature, which has been utilized by this one bank, is like, this is a feature that's been in the market for 20 years.
Yeah, this happens all the time.
It's nothing new, and it can be a negotiated point between the borrowers and the lenders for who has these revaluation rights and how do they happen and how frequently, and are there default triggers that would cause it. Like, this is all part of the negotiation package, but none of it is new. And the idea that someone's reduced the price of some software loans so that they don't have to lend as much against it, it's not. There's not a lot of substance there for why this is a really big story in the marketplace.
Yeah, Andrew commonly refers to it as the retranching of the financial system, of the corporate lending system. And I'd like to underscore with a few stats here the stability of these assets, which the liabilities of the BDCs are assets of the lender. And we turn to an independent academic report here by Chernenko and some other professors as well too, and they looked at the capital structures of BDCs and the performance and historical default rates. First of all, there's never been a BDC bond issuance that's defaulted. That's important to note on the liability side. And then if you look at what banks estimate the probability of default for the non-depository financial institution loans that they extend to BDCs and private credit funds, over the life of those facilities, it's 0.3% and 0.22% respectively. And when you consider the over-collateralization, Chernenko and in that research paper cite, estimate a 95% recovery rate should those loans default. So your expected credit loss over the life of these facilities is 1.25 basis points.
So
I think that's a small number.
So not only is the default rate consistent with the cumulative default rate that you see for single A corporate credit risk, out to 5-year maturity, and well below that of investment grade corporate credit, which is 0.65 basis points out to a 5-year cumulative maturity. Not only do you have a default rate that's consistent with single A type risk, but it's well below the broader IG universe when you look at that 5-year cumulative default period. And so as a result, the ROE on this for banks, they estimate in the paper, is over 50% for banks funding this at a CET1 of 12%. And for banks funding at a 20% CET1, which is very much online with kind of the Basel standards for how much capital would need to be provisioned against this, the ROE on this lending type for banks is roughly 30%. We updated that in our private credit outlook to reflect more recent market conditions, but you're still talking about between 25 and sort of 40% in terms of the ROE.
That's good business.
Facilities.
It's good business. And I think
I think there's a reason why the banks still want to do it.
Yes, and people have been talking about the growth of NDFI loans. It's important to note that yes, that is about 6.5% of their total assets. Meaningful. Only a fifth of that is private credit. So you're talking about 1.5% of all bank assets are loans to private credit funds, right? They're lending at, on average, probably a 25% LTV, right? And again, my example was about one company. They are lending against a diversified pool of loans.
Sure.
So like all of those things together, the idea that this is some sort of systemic risk, frankly, it just doesn't point to it.
Our next topic is defaults. First Brands and Tricolor, which I learned how to say from the Oblots podcast. Thank you, Joe Weisenthal. Quick reaction, Rob.
I think this is, I might agree with you that one of my largest frustrations in some of the reporting that's gone on about the marketplace. In those examples, First Brands had a roughly $3 billion public syndicated senior secured loan.
Yep.
It was not a private direct lending deal. And it was one of the first ones that was held up as the impending defaults in the private credit space. It's not even a good example of a private credit deal. In Tricolor, I guess.
Tricolor is what Joe says.
The largest losers of that deal, when they published who lost the most, and this was similar to a default a couple weeks ago for a UK mortgage lender, the largest identified losers in that deal were banks. So if the whole idea of private credit is it's this shadow thing that occurs outside of the banking system, then how is that deal a good example of private credit when the largest losers were banks? Well, the reality is because it's not a private credit deal. And all these other headlines that are talking about, like everything that we've just talked about in these other topics are talking about largely direct lending, senior secured lending and BDCs and closed-end funds, completely different than those types of deals. First Brands is the closest analog, but it's a public credit deal. It was a public credit deal done to a private company, but that doesn't make it a private credit deal. And look, the overall, and I think you said it well, Alan, when you started off, which is we can look at the broader economy and how are things generally doing. And companies are generally doing well. Last reported, quarterly earnings were pretty good. The stock market was generally trading at okay prices. Those are all the things that are going into the default risk and the instances of default. And yes, there are defaults, and they happen in every cycle. And the default rate today is average. Right. These are not out of the ordinary, and many of them aren't even good examples of private credit in the first place.
Yeah, and maybe just to offer up to your point some data on that, we track defaults across the direct lending landscape, right, using a methodology we think kind of papers over some of the issues that you normally have with published private credit default rates, and also is I think directly comparable to the leveraged loan and high yield markets. So if you look at private credit defaults by count, you can do by volume or by count, but if you look at the percentage of deals defaulting, right, in a trailing 12-month period, at the end of 2024, it was 4.4%. A year ago, it was 3.5%. Today, it's 3.8%. There's no trend there, right, in terms of if anything, it looks like it's improved a bit over the past, call it 14, 15 months, right? And that's actually, Alan, I'll let you opine on this, but that's actually what we're seeing in the syndicated market as well, right? And I think that gets to your point that you made in the intro, which is like what are the odds that the markets that serve very similar borrowers to private credit are seeing their credit metrics improve, but private credit for some reason is not, right? It just wouldn't make sense, and the data shows us that the default rates are in fact either stable or improving together.
Yeah, this is one of the things that I really try to impress upon people through our research and conversations with folks is you can't consider private credit distress in isolation because it doesn't operate in isolation. There are many forms of lending to corporate entities that are financing a similar cohort of businesses, financing similar types of risk. Private credit's chosen for various reasons in terms of execution and some differences in underwriting and that permanency of capital availability that Andrew mentioned. But in general, this is pretty similar type risk across these different markets. And so when you use the same metrics, that Andrew cited for the same methodology, that Andrew cited for looking at high yield bond defaults, as of February of this year, 3.5% for high yield, by count across the market. Syndicated loans 3.8. That's right on top
Sounds
of
like
where
private
direct
credit.
lending is. And by the way, I would also point out, we utilize KBR DLD data for this. They have a very broad universe of coverage, about as broad as we've seen in the market, if not the broadest. And so we'll often see, other firms cited as, private credit's at 10% default or 15% default. And you look at the underlying methodology, it's like, okay, they have coverage of 400 companies and 50 of them are food trucks. I mean, it's not representative of the market. But what is representative of the market is data that's put out by the National Center for the Middle Market that shows that middle market companies have grown revenue 12% year over year as of calendar year end 2025. So explain to me how the sky is, everything's fine, but the sky is falling, but it's only over there.
Right.
It's only in that one part of the sky that it's falling. Yeah. It's a leap of faith that's required to believe that I think people will, on further review, find to be more rational of an argument that it's a leap of faith rather than that's the facts of the situation on the ground.
I can't explain to you how to square that circle, but I think casting aspersions on food trucks is not the right move. So
I mean, I will say the one area as it relates to defaults, you think about what's happened over the course of the past 5 years in the macroeconomy, and I think one of the largest changes has been going from the zero rate environment of 2020, the end of 2021 into early 22, going to a 4 to 5% rate environment. And not all companies and capital structures, especially if you borrowed a lot of floating rate debt, were designed to survive in that environment. And deals done in 2021, typically 5 to 7 year maturity dates. So you're reaching the point when you will have some maturities or lack thereof of things done from that vintage. And Alan, I know you had provided some data to me earlier. When you look at the defaults that happened last year, 95% of them were 2022 and earlier deals. Right? So it's not to say there aren't some companies that may be more prone to default, and there are defaults that are happening. It tends to be from that cohort. And we don't really have much of an expectation that it's going to spread beyond that because, to your point, the economy is generally okay. Yeah. And in a reasonably stable economic environment, it's pretty hard to make the case that default rates should be skyrocketing or even well above average. And they're not. That's what the data shows.
Yeah, it's a great time to be a U.S.-based business, particularly one in the middle market that's more insulated from some of the geopolitical risk and tariff and trade risk and supply chain risk, which is kind of defining of that cohort, which, by the way, accounts for over 75% of private credit borrowers are middle market firms. Yeah. So I think from a systemic perspective, from a default perspective, hopefully we've addressed that one squarely because, again, I think that's where there's a lot of misinformation in the market and not fair characterization or stacking things up apples to apples like we have just here. Yeah. Pivoting to an area that many cite as a potential prospective default risk, which is the software industry. Obviously, AI disruption risk is front and center. I think this is a topic that a lot of the industry is divided on, candidly. And I think that, to be fair, there's many that are still really getting their arms around the extent of the problem. Now, there are many that have also been taking this into consideration for many years now in their underwriting practices. But Rob, you speak with our portfolio managers a lot on a range of topics, but including, this exposure. I know it's something advisors are asking about very regularly. What's kind of your framework for thinking through the software risks that exist in the market today?
In line with the comments I just made before about defaults and vintage, I think there's a reasonable question to ask as it relates to software, and software is a big part of the market. Interestingly, it's almost the same size in the private credit market as it is in the floating rate loan market, in the public loan market. So, these markets are kissing cousins of each other, and a lot of these statistics looks very similar. I think it's reasonable to ask back in 2020 or 21 when these deals were getting done, were people asking the same questions about the future of AI and how it may impact these businesses? And I think 5 years ago, we probably didn't have as great of an appreciation for where AI is going to go as we've thought about it over the course of the past 12 to 24 months. And so there is probably some element of vintage and when were these deals done, and would you still do that same deal 5 years ago as you would today? Maybe not. And when you look at the public loan market where we have full price discovery, and it's one of the other criticisms of price, nobody knows what these things should actually be worth. Well, we have the public loan market. It's got 17% software exposure. Your average software loan year to date is down 7 to 8 points. Now, in the context of senior secured credit, it's a big move, but you're still trading in the low 90s.
Right.
And I think there's also this perception that, every software company is just going straight to zero. Well, look, there's still hundreds of billions, if not trillions of dollars of software exposure in the S&P 500. It hasn't all gone to zero. So why should this software exposure all go to zero?
It's actually trading in line with the index now from a PE perspective, like after having traded it, 40 times or whatever.
So I agree that there is probably some additional scrutiny that managers need to have over their software portfolio, and there will be winners and losers. We have price discovery for how the loan market has started to price in this risk of underperformance, and the software cohort has generated the worst performance year to date, but every private credit fund isn't going to zero because it owns some software.
No, I mean, I think it's, to your point, it's reasonable to question the software economics writ large, right? Like software produces digital bits, right? That's kind of the business, and the price of those bits is going down because it's being commoditized. I think for an industry that has the highest margins in the economy, it is reasonable to question whether those economics are going to continue, and that's why you've seen the equity multiples collapse. That makes sense, right? What you don't see is immediate cash flow degradation. You're not seeing that anywhere, right? These businesses have locked in revenues. Those we're not seeing churn, spike. I think the right way to think about this is there's going to be dispersion here. There's tons of uncertainty, I think, broadly. There's going to be dispersion. Dispersion is not good for credit, right? I think we can, on the equity side, you can have winners and losers. In credit, you don't really want dispersion, right? So I think it makes sense that people are concerned. That being said, I think the way to think about this is it's more of a refinancing issue a few years down the road than it is a current cash flow issue, right? And if it's a refinancing issue, what you care about is what was the entry, right? Did you finance this thing at a 25 times valuation multiple and 8 times debt to EBITDA? If so, it's going to be tough to refi that down the road, maybe, right? If the business is challenged, right? If you financed it, 15 times EBITDA valuation with 5 or 6 times debt, that's a lot more reasonable, and you've got more degrees of freedom around that, right? So I think, again, vintage is important, not just because did you know ChatGPT existed or did you not when you originated the loan, but what were the prevailing capital markets context when you made the loan, right? Is going to have a big impact on ultimately, can you get the proceeds you need in a refinancing?
Yeah, a 2021 vintage software loan or a 2026 vintage software loan are very different propositions. There have been a lot of things that have changed since then.
And I would say at the top end, the jumbo loans, the biggest loans, $1 billion plus loans, over the past 5 years, 40% of the dollar volume there is software. Now, it's still a minority of the market, right? It's 15, 20% of the market is jumbo loans. But a lot of that's been software. So I think if we're talking about where in the market can you mitigate that exposure to the greatest extent, it's lower middle market's been about 10% tech, right? So maybe 8% software or something like that, right? And in the upper part of the market, it's more than double that as a ratio. So there are big segmental differences here as well.
And I think that should highlight another point for investors too that we've talked about many times, which is capital concentration issues. And the need to consistently do big deals to deploy the rapid inflow of capital that some of the largest managers at the top end of the market have, and that it's not that these managers were over bullish, more bullish than the rest of the market on software as a fundamental business. That doesn't necessarily explain why their exposure to the industry is so much more.
No.
But software's been a business that's had, good defensible margins, predictable revenues,
it's a good business
models, and has justified, 6+ turns of leverage when, the rest of the market might have justified 5 to 5.5. It helps meet your deployment needs that you have if you're a large lender rapidly raising capital that's got to consistently deploy, into very sizable deals. And so, I think that's kind of evidence of one of the outcomes of capital concentration that we talk about a lot, is not just kind of the compression of terms and pricing and that sort of thing, but it affects the makeup of the portfolio that you can build. And when you think about what deals are coming to market today that are large enough to absorb some of that capital, a lot of it's AI-related risk. still some software in certain parts of the market. But in an on-the-run market, you can only resemble the composition of deal flow that's coming to market to be offered. And so, that's what those funds are going to look like. So if you want something that kind of counterbalances other parts of your portfolio and provides that diversification to those, tech sector, software-related risks, you probably need to look to other parts of the private credit market.
And I think one thing that you said just reminded me of this, which is I wonder too, and sometimes when people talk about software and technology, does the mind of the average observer just go to venture capital and say, oh, okay, well, this is, it's risky stuff. These software tech companies, who knows if they'll exist in a few years. And that's largely not the case of what gets financed in private credit. Your typical lenders are looking for EBITDA and cash flow and recurring revenues. And that comprises a lot of what these businesses are. And you made the spot on, which is, my 26 years in credit, I financed a ton of software businesses because they were great companies that had 90+% recurring revenues and really high cash flow.
Low customer concentration.
They perform really well and make a lot of money. And that tends to be the types of deals that comprise a lion's share of a lot of the financing that's gone on within both public and private credit to software businesses. It's not venture. Private credit doesn't do a lot of. Yes, there are some.
There's
venture
a thing called
lenders.
venture debt, but that's not this.
But that's not what most of this industry is. Yeah.
And I think one of the things we haven't touched on related to this topic is, if you're going to assume that there's this level of software, AI-driven disruption, that subsumes that there's also massive AI benefits that are being harvested in some part of the economy that's causing businesses to pivot toward AI solutions as opposed to their incumbent software solutions. That likely means that there's a whole cohort of companies out there outside of the tech software industry that will be AI beneficiaries, reaping the productivity gains that AI brings forward without the same kind of CapEx and monetization risk up front that the AI builders face. And so that's something that can kind of offset if there's the increase in distress in the software industry. Maybe there's some other firms in the industrials and healthcare and other industries that kind of get some productivity gains and enhancement to margins.
I think that's reasonable.
As a result.
Yeah.
So the conversation on software leads nicely into the next topic, because as software risk has been kind of forefront for folks, there have been questions about valuations and valuation processes. And to the extent that all of these software companies are instantly in distress, shouldn't the valuations reflect that more fully? Rob, this is a common, topic of discussion.
Yeah.
I think it's one of the more poorly understood aspects of the space. It is an illiquid asset class to an extent. Valuation is a risk always. I would point out it's also a risk with public markets, that a liquidity-driven sell-off could, erode what was the pricing at that point in time. And that's kind of like a penalty for liquidity in some cases, to not have more patient capital. And, how you're valuing is not just market traded, what's kind of being, midpoint of the bid-ask spread in private markets. There's more to it.
One area that is often missed in talking about valuations and branding the whole private credit space as being very opaque and nobody knows what it's worth. One of the things that is missed is that a lot of these funds that are talked about in the media and in the press are 40 Act regulated vehicles, BDCs, interval funds, closed-end funds. There are fairly strict SEC regulations that cover how these funds have to fair mark their assets and fair value their investments. As a result, most of these funds have gone out and utilized third-party valuation firms to do their valuations. And without a doubt, there is some art in addition to the science in coming up with the value of a private asset. But many of these articles say, oh, well, this asset was priced where it was because the manager just wanted to price it there. They deliberately didn't change the price. And a lot of times, just at a very high level, just misses the point that the asset manager isn't really the one that determined the valuation in the first place, that they have hired third-party independent valuation firms that are leaders in the market for coming up with these types of values, that are really the ones that have the first call at what should these positions be worth. I do think, again, and we've talked a lot about this, the private credit market is very similar to the public loan market. The public loan market is down about 0.5% year to date. So your average loan price is probably down 1 point, 1.5 points. And we talked about software where your average price is down 7 or 8 points. But I think also for the chorus of folks that are saying, well, these private credit funds, all those loans are priced way too high. They should be down 5 or 10 points or whatever. Well, when earnings are good and we don't have defaults and things are pretty good, in the loan market, companies are doing pretty good, default rates are relatively low, their prices aren't down, and you have full price discovery because it's the public loan market and loans are quoted and traded. And you have price discovery for the same types of assets that are owned in these private credit funds. They're not down all that much.
Yeah.
So when you run into some stress situations, does it sometimes take time for some of these third-party valuation firms to equalize around what is the right value for some of the assets? Yes, but it's not some major indictment that just because you own something as private credit, then it becomes impossible to value.
Yeah, I mean, this market's been around for a decent amount of time, right? A couple decades. The market's changed over time. But I think we do have enough history to look at a market that's been around this long. If there were persistent valuation issues, it would have come out by we would see the impacts of that by now, right? You look at the market, you've got thousands and thousands of loans outstanding in this market. If you want to go through and say this loan doesn't match this, or this was at 100 and now it's here, you can do that, right? And there's going to be places where there's, to your point, delayed marks, two lenders that don't agree, two vehicles that don't agree on a mark, timing issues, whatever it might be. But that's not really the concern for investors, right? The concern is that there is broad-based inflation of valuations in private credit, right? That's the concern. And we can check that, right? Because when would that end up coming out in the wash? It would come out when you have a stressed period, right? You actually start to have real credit losses. So we can look back at the GFC, at the energy downturn of the mid-2010s, at COVID, right? And we can look back and say, okay, how much did the private lenders how much were the private credit books marked at that time versus what were the ultimate credit losses or the realized credit losses, right? And across the board in all three of those cases, the unrealized losses were double what the eventual credit losses were, right? If firms were hiding credit issues, right, and then the GFC happens, that should mean that all of a sudden the realized credit losses go beyond what the mark-to-market was. Right? The opposite happened, right? So actually what it shows us is in these stress periods, the industry was more conservative than it ended up needing to be, right? So I think, look, every there's going to be differences across the board. It's important to look at valuation policies, right? That's a critical part of doing due diligence on a lender. But by and large, from an asset class wide perspective, there's just no evidence of it.
Yeah. I agree with everything that's been said. And I would even offer even a more simple just smell test, right? I think a lot of the things we're talking about, if you boil it down to the most simple of ways of assessing the situation, it's pretty apparent that some of these things that are being floated just don't pass the smell test. And to that end on valuations, what I'd offer is the income's real. If valuations are systemically higher than what they should be, then where's the income coming from? And if valuations were overvalued by, call it 5 or 10%, then what you're really saying is, okay, then the income is actually 11 or 12% yielding as opposed to, 9 to 10% right now.
Yeah.
And, to Andrew's point, the valuations sort of, kind of come out in the wash over time, and you see how much in credit losses funds book.
You can't carry a loan for 10 years.
Exactly.
Eventually it'll pay off or it won't pay off, right?
Exactly. And in the meantime, the income continues to be paid. And so, to me, that is proof that if you think about what's a comparable instrument in the market, the BSL market, for example, pay in terms of the level of income and where's that value, and you look at the level of income being paid in private credit, what should the value of that be? Well, by that basis, I struggle to see where there's this chronic overvaluation.
That's a good point.
And look, prices do change. And I think sometimes there's examples, it was valued at 95 cents on the dollar 3 months ago or 6 months ago, and today it's valued at 70. What a disaster in the valuation method. But like, there is new news on some of these names sometimes. Right. The same reason stocks sometimes have a bad day and the stock goes down 20% because the company just reported earnings. There's new news. They lost a customer. The outlook is worse.
Claude came out with a new.
I mean, it does happen. Agent. It happens in credit also. And just because some loan deteriorates and the price falls is not an example that the price was inflated 6 months ago. People might have thought the business was basically okay 6 months ago, and things change. Yeah. But to your point, Alan and Andrew, like, it does wash out over time.
And we've got enough history at this point to see if there was something to wash out.
Yes.
Right.
Yeah.
So, Rob and Andrew, we've covered a lot of topics. I've really enjoyed this conversation, and again, like we said in the intro, we really hope this has been informative. Obviously we have our views, but we really try to be grounded in the data that we're seeing in the market and communicate that hopefully in a way that folks feel is kind of circumspect and provides full context on the issues. And so in this last portion of the conversation, I'd like to offer up the opportunity for each of us to maybe double click on a part of the conversation today, or even a topic aside from that you find to be maybe kind of most misunderstood in the market, or is maybe most important to really getting at the heart of how private credit is doing today. And I'll take the liberty of kind of kicking off. I think on the topic of systemic risk, I think this is something that's very poorly misunderstood. I think at a fundamental level, what has happened with the growth of private credit? Well, you've had more of the corporate credit risk that's within the economy move from within the banking system, balance sheets that are highly levered 10 times plus, funded by short-term, very liquid, fast-moving deposits potentially, and very little equity has been moved into vehicles that are typically funded, debt to equity 0.7 to 1 times debt to equity, and with matched term financing. You've addressed liquidity risk in the structure that wasn't addressed in the previous regime when these assets were in the banking system, and you've addressed asset liability, mismatch risk, which wasn't addressed, in the previous regime, leaving the credit risk, which is what people want the exposure to be compensated for in the form of income. I think when, that is a very, good development for the, consistency of credit creation across multiple cycles within the economy. I think it makes our credit provision system more resilient. And I would also draw contrast in the potential risk of private credit to the system, relative to past episodes. So when you think about the private credit market size today, U.S. private credit called $1.5 trillion in total assets. The economy is $31.4 trillion in size. If you look at the mortgage market in the U.S. back in 2008, the mortgage market was $14.8 trillion in outstanding debt in an economy of $14.9 trillion. So when you look at the disparity of the potential impact to the economy, I think we always like to normalize the size of the economy when keeping things in relation. And when we do, another thing that we commonly cite is the decrease in the overall aggregate leverage credit market that's occurred in recent years. If you look at the size of the market, back in 2020, and this includes high yield, leverage loans, bank commercial and industrial lending, and private credit, both BDCs and closed-end funds. At year-end 2020, the size of the market was 27% of GDP. Today, that number is about 23% of GDP. And by the way, it's stair-stepped down each year since then, which coincides with private credit's period of its most rapid growth. You might say, okay, well, it's been a really good economy. It's been a really healthy market. Maybe there's been a growth in issuance in other parts of the market. Well, over the same period, total non-financial business debt outstanding has also declined from 92.3% of GDP to 71% of GDP at the end of 2025. The corporate sector in the United States is deleveraging, both across the board and within the part of the market that private credit operates within. That is a de-risking. That is not an increase in financial instability and systemic risk, which, by the way, in every major recession or depression that we've observed We've got a chart on it in Is Private Credit a Bubble? Back to 1750. You've seen a rapid rise in
I don't think you went back far enough.
I would agree.
Well, I actually know somebody who's working on establishing the financial ledger for the Bank of England in the 17th century right now. So I'm looking forward
I'm sure
to
our listeners would love to hear about that.
Maybe we have them on as a guest. But in any event, you've always seen, credit bubbles burst, preceded by a rapid rise in the level of private sector debt to GDP, and in particular in the part of the market that is the principal point of concern for that stress period.
The biggest thing is folks are sort of turning their back on private credit, and there's a lot of headlines, and I think we understand the reasons for that, and we've tried to address some of those today. I think there's reasonable questions to be asked for every asset class, right? An asset class grows and it expands, and more people are touching it, and it's only natural that people are saying, hey, am I being paid? Am I being compensated for the risk I'm taking? And I think that's part of what's happening here. And I think I would point to, we've got, again, decent data on this asset class. If you look at private credit returns and you unlever them and you take out the fees, over the past 12 years, that's about as far as we have this data, it has outperformed HYG, the high yield ETF, and BKLN, the loan ETF, by between 250 and 300 basis points per year, right? So per year. And that's, again, apples to apples. We're taking out fees. We're unlevering it. This is just the pure return on the assets, right? So, when you think about, well, I'm sort of, I don't like this unknown risk, this left tail risk in private credit. I think we've tried to address that. I think if you just consider it as just, another asset class in your toolkit, right, that can deliver you meaningful outperformance of other options that have similar credit risk. At the end of the day, that's what we're talking about here, right? Private credit has credit risk. If the economy goes bad, there are going to be defaults, right? That's just the normal course of lending to companies, right? So I think there's the other side of this, which is when you are, turning your back on the asset class and looking elsewhere, where specifically are you looking? Because there is, an opportunity risk here that you're giving up, which is 250 to 300 basis points of outperformance from the illiquidity premium that we talked about.
Yeah, and from my perspective, some of the things that I see is most mischaracterized. And I know Andrew said we got to be calm and cool and collected in this podcast and try not to
Feel free to it's the end, Rob. Get fired up.
I mean, first and foremost is just a misunderstanding in so many places about what is private credit and how is it different than public credit. And the number of times that public credit transactions are held up as private credit deals to then create a boogeyman, it really infuriates me. The other thing is this idea that public credit is just inherently safer because it's done by the banks. And that's also...
Who aren't holding the risk.
Well, that's exactly right. The public loan market is not a market held by the banks. It's held by third-party investors. Those things are largely out of the banking system in the same way that private credit is out of the banking system. And it's also infuriating to me that somehow if a loan was a public loan, which if the folks that talked about it even knew what that really meant, that it's just somehow safer because it's public and not private. And that's completely wrong. And then lastly is just this idea that private credit lives in a bubble that's completely separate and different than everything else in the financial markets. And it's just not true. There are a lot of public market, tradable, observable things to private credit. It has the same fundamental risk drivers of private credit are the same as public markets. And if everybody feels reasonably good about everything else, you should probably feel reasonably good about private credit. And I think, all of that collectively just creates so much misinformation that it makes me very frustrated in reading a lot of these articles about private credit because it just doesn't properly frame what they should be talking about and then what the key risk is that's attempted to be discussed.
Well, to bring it full circle with the intro, what we've just talked about is the valley of despair. And, when we try to look ahead, and I think a big part of this conversation is really to address the leading concerns that will allow people to take, to move to that next step along the Dunning-Kruger curve to what is called the slope of enlightenment. It sounds like a magical place. I would love to be
I would love to go there. I'm not sure I can afford it, but
but I'm curious, what does that mean, to each of you? If you look at the description of the Dunning-Kruger curve, it's where knowledge has sort of reached a level, of expertise. You're aware of the limitations that you have. You're aware of things that you don't know, but they're not fearful to you. You feel comfortable and you understand, okay, I don't have the level of confidence that I had when I first engaged with this thing, which turns out a lack of knowledge and just hubris.
Yeah.
But I'm reasonably well informed. I'm kind of more balanced in my perspectives. And that's the slope of enlightenment.
Yeah,
I'd love to know what that looks like to you.
I'd say two things real quick. Like, number one, sort of what I mentioned before. I mean, just simplify the asset class a bit. As you learn more, I think you can simplify more, which is, I think, one of the best things you can do when you're learning about an asset class, right? And I think, look, private credit, number one, you have the illiquidity premium, and number two, as we mentioned, these lenders are originating for their own book, and some of them, I would argue, have the ability to drive alpha on top of that illiquidity premium. That's what you're investing in, right? You're giving up illiquidity, and you're looking to pick talented managers to drive a couple hundred basis points of outperformance, right? It's kind of that simple, right? And you're taking on credit risk to do it, right? And the second thing is, I think, and we're going to put a piece out soon on this, understanding the different segments of private credit is incredibly important, right? This is a big asset class now. There are big and growing differences between the different lending segments, between the lower middle market, non-sponsor versus sponsor, upper middle market, large cap lending, asset-based finance. There's all these different parts of private credit that do different things, and understanding the differences and what that means for both risk and return, I think, is critically important in this moment.
What's the slope of enlightenment look like to you, Rob?
Wow. I don't even know if I know how to answer that. I think I've done my 10,000 hours in credit.
Yeah.
I would like to think I've seen a lot of different things, been a credit trader, a portfolio manager, an analyst, talk with a lot of folks about private credit offerings and public credit strategies.
This is a true credit guy. He can't come up with anything optimistic.
I know. I mean, I would like to think that at the end of the day, the market continues to perform the way it is, that some of this misinformation-driven hysteria starts to abate, and what you're left with is an asset class that's done really well, and it's really helped generate higher income and higher returns in portfolios.
Yep.
It's had a moderate degree of volatility, and those attributes aren't changed, and it does require accepting a limited nature of liquidity. You can't really access it in a mutual fund. That's why it doesn't live in a mutual fund. But for being willing to accept, some of those limitations and how the business has to be done, it's an asset class that's really performed for people over a very long period of time. And I don't think that there's a fundamental risk to that. There is always fundamental risk to credit. There are default cycles, and the economy goes down. We enter a recession. You get dispersion in managers and how people do in those different environments. But that's the same for every asset class, from public equities all the way on down. I think private credit has a long track record of being a really great place for people to invest. And I don't think that changes over the long term, but it is certainly battling a barrage of negative headlines at the moment.
Yeah, and look, ultimately, performance will bear it out. I mean, if what we're saying is true, that really the economy is in good position, that supports credit performance. You don't have a preponderance of bad assets that are in the space and uniquely in the space. It'll kind of bear out over time, and I think that'll be the greatest proof in the pudding. And hopefully with private credit's got a 20-year track record now of strong performance. Maybe it needs just a little bit more to prove some of the doubters wrong. With that, would say thanks, Andrew, as always, but Rob, thanks for being a special guest today.
Yeah,
joining to talk credit. Greatly appreciated your insights, and again, hopefully this conversation was helpful, educational, and informative For further education and insights on how we view both private credit and other parts of private markets, please check the link in the show notes for the 2026 Private Markets Outlook. And if you enjoyed this episode, we'd be thrilled to have you like and subscribe. Thanks for joining, gentlemen.
This was fun, Alan. Thanks.
Yeah, thanks for having me.